When you enroll in a marketplace plan, you'll likely be inundated with and possibly overwhelmed by acronyms: MAGI, HDHP, OOP, and a lot more. So what are HSAs? Well, that's what we're going to talk about in today's video. So today we're going to be talking about HSAs, which are health savings accounts. But before we get too far into today's video, a friendly reminder, please make sure to subscribe to stay up to date because we do release these videos on a weekly basis. And of course, make sure to click that like button so we can get this information out there. Now, if you have any questions whatsoever about a marketplace plan or any type of health insurance, you can reach us in the comments below, and you can always give us a call at the number on the screen. We are licensed nationwide and there's absolutely no charge for our services. Okay, so let's get to the main topic at hand, which is, of course, HSAs. HSAs are health savings accounts, and they are just a basic savings account that's meant to be used for medical purposes. It is your account with your money and your name on it. And you can withdraw the funds either with a credit card or a check to be used for qualified medical expenses. Now, you do have to use these funds on qualified medical expenses, but the list is quite extensive. It ranges to more extensive things like emergency services or hospital stay or ambulance ride, all the way to more basic things like bandaids and ibuprofen. So it's really quite extensive, and you can use your HSA on a very, very large quantity of items and services. You can pretty much use the funds in your HSA for almost anything medically related except paying your premium. So how do HSAs work? Well, basically, you contribute a certain amount of your income, and that is pre-tax. And the IRS sets these max HSA contributions every year. So in 2023, the max HSA contribution for an individual is $3,850, and for a family, it's $7,750. Now, however much you choose to contribute is pre-tax. So this will help you not only when you file taxes, because it's going to lower your taxable income, but it can also lower your MAGI, which may make you eligible for premium tax credits, which could save you thousands of dollars in monthly premiums. Basically, your eligibility for a premium tax credit through the marketplace is determined by your household size and your income. So by lowering your income by perhaps contributing to an HSA, you may push yourself into a different bracket wherein you're eligible for a larger premium tax credit. Now, these are major monthly savings, and it really could save you thousands of dollars per year. So it's certainly something to look into, especially if you're right on the brink of being eligible. HSAs are also interest-bearing accounts, and that interest is not taxable. And as long as you withdraw funds for a qualified medical expense, that's not going to be taxed or penalized either. Now, the funds roll over from year to year, and how you use it is up to you. You can, of course, use it for a qualified medical expense, and truly, even if you didn't have large medical expenses in the year, because it's eligible for things that are so basic like Band-Aids, you will still be able to use your HSA, so that's one option. You could, of course, leave it alone entirely and let it just accrue interest, and you can even invest a portion of it. And then if you hold on to your HSA until you turn 65 and you retire, you can use it as a basic retirement account. So this is why people refer to HSAs as having that triple tax advantage. They're a great way to build wealth and build a retirement fund. So that's why many in the FIRE community, which is that financial independence, retire early community, are very into HSAs. But HSAs are not for everyone, and it's very, very important that you understand that before you are lured in by that triple tax advantage. For example, you have to really have some extra free capital in order to take advantage of an HSA. If you don't have a significant amount of money that you can contribute towards your HSA, then you're really not going to be able to take advantage of those benefits. Now, even if you are somebody who plans on using your HSA just for medical expenses, then it's probably going to be a wash, more or less. But if you're somebody that wants to build wealth in any way, you need to make sure that you do have a little bit of extra capital to pay for any additional medical expenses that may arise. Another potential downside is that HSAs are only available with high deductible health plans, or HDHPs, another one of those acronyms you've probably seen thrown around on healthcare.gov. Now, high deductible health plans are just that. They're plans with higher deductibles. So you're going to have to spend more out of pocket before your insurance begins to contribute to the cost share. And like the maximum HSA contributions, there are limits set every year. So in 2023, the minimum deductible for a high deductible health plan for an individual is $1,500, and for a family, it's $3,000. Now be aware, I said that is the minimum. It's highly unlikely that you're going to find a high deductible health plan with an HSA that has a minimum of only $1,500 or $3,000. So it's highly unlikely you're going to find a high deductible health plan with such a low high deductible. So do be prepared to spend more out of pocket if this is the route that you're going to go. Now that being said, there are still many services that are covered even prior to meeting your deductible. And there are many services that are covered at no charge to you. So if you're somebody that plans to take advantage just of the more basic healthcare services, then this could still be an option for you. Basically, don't let your desire for an HSA outweigh your need for adequate healthcare coverage. Now, I will also say that very often plans with higher deductibles tend to have lower monthly premiums, so you could see an additional cost savings there as well. Still in all, you want to make sure that the plan that you're choosing is right for your needs. So generally speaking, someone with more extensive medical needs might not benefit from a plan with a higher deductible. You might be better off with a plan with a lower deductible, even if those monthly premiums are a little bit higher. You just want to make sure that your insurance begins to contribute to the cost share a little bit sooner. But if you are somebody who is relatively healthy, then a high deductible health plan might be a great option for you. It could be an option for you to save money on those monthly premiums, perhaps have access to an HSA, and of course still provide coverage should you need more extensive medical care. Remember, you can only continue to contribute to your HSA as long as you are enrolled in a high deductible health plan. So if you enroll in a high deductible health plan one year with an HSA and the next year you decide that it's not really for you, you'll still hold on to the funds in that HSA, you just won't be able to actively contribute anymore. If you have any questions whatsoever about HSAs and HDHPs, please feel free to give us a call at the number on the screen, or you can reach us in the comments below. And as a reminder, please make sure to subscribe to stay up to date. We do release these videos on a weekly basis, and make sure to click that thumbs up so we can get this information out there. As always, thank you so much for watching. Bye-bye.